Welcome to the Note Nuggets podcast, where you can learn how to become the bank, build wealth, and accumulate streams of income perfect for your savings or IRAs. You'll hear from industry experts, seasoned veterans, and everyday investors. Our goal is to teach you how to invest in notes, one nugget of knowledge at a time. Here's your host, Kevin Galang.
Welcome, everybody, to this week's episode of the Note Nuggets podcast. First of all, I want to thank all of you who have listened to the first 5 episodes of the show, and I appreciate your feedback. We are on this journey to learn and earn together. If you haven't checked out those 5 episodes, they are live on all the major podcasting platforms, or you can go to notenuggets.com/podcast. Now, my goal for this podcast is to break down this awesome investing strategy, one nugget of knowledge at a time, which leads me to the title of this episode, Secured or Unsecured? Which investor are you? Do you or would you invest in unsecured debt, or do you only invest in secured debt? I'm going to define the 2 types of debt and give you some examples and perspectives on how to approach it. Before I dive into the episode, don't forget to subscribe to receive episode updates, additional weekly note nuggets about note investing, the note industry as a whole, and access to full interviews with guests. To subscribe, all you have to do is head over to subscribe.notenuggets.com, or you can sign up at the bottom of the show notes, which are notenuggets.com/secured-unsecured. So here is an epic fact for you. Did you know that in 2019, the U.S. had $14 trillion in consumer debt? Yes, trillion with a T. Now, as of May 2020, Jeff Bezos, the richest man in the world, is worth roughly $149 billion. Now imagine you had a small village of 100 of Jeff Bezos. Then you'd have roughly the same amount of money that we as Americans spent on consumer debt in 2019. It's an insane amount of money. The average person on the street will see that amount of debt and think, that's a lot of money. And they'd be right. But if you are listening to this podcast, you're not an average person. You're taking action, educating yourself, and taking control of your financial success. You're learning to see how other people's debt can be an opportunity for cash flow and wealth for you and your family. So let's talk about that debt. According to debt.org, where I got this information, U.S. consumer debt is then broken down into 4 different categories: mortgages, home loans basically, auto loans, credit card, and student loan debt. Mortgage and auto loans are secured debt. Credit cards and student loans are unsecured debt. Secured debt is tied to something real. Mortgages are tied to real properties. They may be owner-occupied homes or investment properties. People have mortgages on apartment complexes. So there are different types of asset classes within real estate that mortgages are tied to. Auto loans, of course, are tied to vehicles of all shapes and sizes. In the industry, this is known as collateralizing. An asset that's tied to a note is called collateral. The advantage of secured debt is that you have something to come after if the borrower doesn't pay. As a lender, you have a layer of protection for your investment. If the borrower stops paying or can no longer pay, you can take back the house or car to make your money back. It's less risky knowing that you have some type of a backup plan in the asset. The disadvantage of secured debt is that, generally speaking, the interest rate is lower. Think about mortgage rates today. We're at record lows. Another disadvantage of secured debt is the timeline. Mortgages are usually longer timelines, like 10, 15, 20, 30. I've even seen 40-year loans. And auto loans last about 5 years. So it's definitely not a get-rich-quick strategy. Anybody that tells you otherwise, I would walk away. So if you're using a retirement account to invest, that time frame doesn't really matter to you. So for example, if you're in your 30s like me, you can't touch the money until you're at least 59 and a half. So the timeline isn't necessarily that big of an issue if you're using an IRA, for example, to pay for that. Also, if you are risk averse like me, you get the advantage of protecting yourself with the collateral of the note. On the opposite side of things, let's talk about unsecured debt. Credit cards and student loans are not secured by any assets. So if the borrower fails to make their payments, there's nothing you can go after. According to WalletHub, the average interest rate on a credit card is 15.10%. If you have excellent credit, it can be as low as 14.08%. And if you have fair credit, the interest rate is a whopping 23.43%. So if you buy someone else's credit card debt, you could be entitled to a high interest rate on your money. Another advantage is that credit card debt typically doesn't have a time frame it needs to be paid off by. As long as the borrower has a balance on the credit card, the interest keeps accumulating. On the other side of things is that there's a possibility it can get paid off rather quickly. If you were expecting maybe a 5-year payout and they pay it off in 2 years or 2.5 years, there's no prepayment penalty, so you run that risk as well. So there's a level of uncertainty you have to be aware of. Student loans, the last category, according to debt.org, is another form of unsecured debt. The average student loan interest rate for undergraduates is around 4.79% and 6.36% for graduate student loans. While these interest rates aren't as high, one thing is for certain, student loans cannot be wiped out even in a bankruptcy. All the other debts can. After hearing about what secured debt is versus unsecured debt and different ways of looking at it, you might be asking yourself, what should I invest in? The answer, and I'm sorry to say this, is that it depends. It's really up to you. So what you need to do is ask yourself a few questions. What is my risk tolerance? What time frame am I looking at for growing my money? And lastly, what money am I using to buy this debt? Is it a savings? Is it an IRA? Is it a checking? These are questions you need to ask yourself. Be honest and reasonable, but ultimately these are your answers. When you have those answered, you can kind of figure out exactly where you want to go next. If you have any questions about this episode, don't hesitate to send me an email at kevin@notenuggets.com or book a time on my calendar by going to contact.notenuggets.com. I hope this episode provided you with additional insight as to how unsecured debt and secured debt operate and different ways of looking at it. Until next week's Note Nugget, thanks everybody.
Thank you for tuning in to this week's episode of the Note Nuggets podcast. Be sure to subscribe to the show to get access to additional weekly value nuggets and get notified with episode updates. To subscribe, all you have to do is head over to subscribe.notenuggets.com. If you have any questions about this episode or note investing, book a time on Kevin's calendar at contact.notenuggets.com. We'll see you next week with another note nugget to add to your tool belt.